All right, let's talk Forward Air. Their latest earnings report is, well, it's a bit of a head-scratcher. You've got management on one side telling this story of a disciplined, successful turnaround, and then you have the market on the other side just hammering the stock. So, what's the real deal here? Discipline or just plain disappointment? We're going to dig into the numbers and see if we can figure out who's right.
And when I say the market reacted, I mean it was swift. The stock dropped a whopping 5.2% almost the second the earnings call ended. That's more than just a little disappointment, you know. It's a pretty clear signal that investors just weren't buying what management was selling.
So you see the setup here, right? It's this classic Wall Street story. The market sees a big miss, red flags everywhere. But management, they're pointing to all this great progress happening under the hood. So the big question for us is, what's the real story behind these numbers? Let's unpack both sides and see what's actually going on with Forward Air.
Okay, so let's put on our detective hats, because we're basically looking at a tale of two completely different reports that somehow came from the exact same set of numbers.
So what caused that big stock drop? Well, it really all comes down to the headline numbers. First up, revenue. They brought in $619 million, but the street was looking for something closer to $628 million. So a miss, but not a huge one. The real shocker was on the bottom line, the earnings per share. Wall Street analysts were expecting a profit of about 22 cents a share. Instead, the company posted an official GAAP loss of 41 cents. I mean, that's a huge swing. And from the outside looking in, yeah, that looks like a pretty big problem.
But here's where management says, hold on, look closer. They're telling investors to look past that official accounting loss and focus on a different metric called EBITDA. Think of it as a better gauge of the company's core operational health. And when you look at that, the story completely flips. Consolidated EBITDA actually grew by $5 million from Q1 to Q2. So even with that scary headline loss, the underlying business, it actually got more profitable from one quarter to the next. Interesting, right?
So to really get why that EBITDA number is growing, we've got to dig a little deeper than just the headlines. We need to look at the specific operational metrics that management was so excited about on their call.
And yeah, when you start digging, you can see why they're optimistic. Check this out. Their income from just day-to-day operations, it swung from a loss to a positive $20 million. That's a huge shift. Their main business, Expedited Freight, had its best profit margin in a year and a half. And that big Omni Logistics acquisition they made, it's already looking like a huge win, with its own profits up a massive 47% year over year. Oh, and on top of all that, they're sitting on a really healthy pile of cash, about $368 million in total liquidity. So, the picture inside looks pretty good.
So the question is, how are they pulling this off? Especially when the whole freight market is, not doing so great right now. Let's break down the playbook that management laid out on their earnings call.
It really comes down to a three-part plan. Super simple. Step 1, get the pricing right. They're making smarter, corrective actions to make sure every piece of business is profitable. Step 2, control the costs. They're being super rigorous about spending. And step 3, make the most of that Omni acquisition. The heavy lifting of the integration is done, so now it's all about optimizing that combined network.
And the CEO, Sean Stewart, he really drove this point home on the call. He said, and I'm quoting here, "It takes discipline not to sacrifice service." Basically, he's saying that even while they're cutting costs, they refuse to let their quality slip. The big long-term bet here is that this reputation for great service is what's going to give them pricing power and drive growth when the market eventually picks back up. And this idea of discipline ties right into their pricing strategy. Something really interesting came out in the Q&A session. A lot of their competitors use what's called a GRI, a general rate increase. It's basically a blunt instrument, right? They just hike prices across the board for everyone. Forward Air is doing the exact opposite. They're using what they call an SRRI, a strategic rate increase. It's way more surgical. They actually work with each customer lane by lane to make adjustments. It's about creating a partnership, not just slapping on a price hike. Totally different philosophy.
Okay, so if things inside the company are actually improving, what gives? Why did the stock get absolutely hammered? Let's flip back and look at this from the market's perspective.
And this is really the heart of the whole issue. It's a total divergence in focus. It's like management and the market are speaking two different languages. Management's talking long-term, look at our sequential EBITDA growth, look at the margin improvements. This is a multi-year turnaround. Meanwhile, the market, it's all about the here and now. It sees the headline GAAP loss, the revenue miss, negative cash flow, and a whole lot of short-term uncertainty.
And we have to remember the bigger picture here. The whole freight industry is in a bit of a recession right now. Specifically, demand for what's called LTL, or less than truckload shipping. For smaller shipments that don't fill up a whole truck. That demand is soft pretty much everywhere. Now, on one hand, that makes Forward Air's ability to actually improve its profit margins even more impressive, but on the other hand, it totally explains why investors are so jumpy about any sign of revenue weakness.
Okay, we've heard both sides of the argument. Management's story, the market's reaction. Now it's time for our take. Let's make the call. Is this a bull or a bear story going forward?
So, what's the final call on Forward Air?
Let's break it down. The bull case, the discipline argument, is pretty strong. The operational turnaround seems real. EBITDA and margins are getting better. That smart pricing strategy is paying off, and the massive Omni integration is finally in the rearview mirror. But the bear case, the disappointment argument, is just as clear. Those GAAP losses are real. The free cash flow is negative, the overall freight market is still soft, and there's this big question mark hanging over the company because of an ongoing strategic review.
So putting it all together, our rating is market perform. Look, the company is doing a lot of things right internally. The discipline they're showing is really impressive. But you just can't ignore the headwinds. Those GAAP losses and the tough market environment are significant. For now, we think those forces are pretty well balanced, which justifies the market's cautious stance and the current stock price.
Now, for the trade idea, remember that strategic review I mentioned? That's basically corporate speak for, hey, we're looking at all our options and we might sell the company or a piece of it. We have no idea what's going to happen or when, but whatever the announcement is, it's almost guaranteed to cause a huge move in the stock, one way or the other. So for a trader, instead of betting on which way it'll go, you could consider a volatility play, using long-dated options to basically bet that a big swing is coming, capitalizing on the uncertainty itself.
And, as always, please remember, this is not financial advice. Make sure you do your own homework and research before making any investment decisions.